Hello everyone, welcome to Validus Trading Academy. For those of you who don't know me, my name is Simona and I'm part from Validus educational team. A few words about me. I'm an expert Forex trader since 2016. I trade mostly Forex pairs, cryptocurrency pairs and commodities. I look forward to share my experience with all of you here and build successful strategies so you can develop your trading abilities in the best possible way. So let's start with our first lesson, first steps in Forex. Financial world is full with specific terminology. In this first lesson, we will start learning the basic words we will need in order to understand each other. So Forex, let's start with Forex. Forex, also known as the foreign exchange market. Forex is the market where one currency is traded against another. Some of the market participants exchange foreign currency for their own, like multinational corporations who must pay wages and other expenses in different nations where they sell their products or services. However, a large part of the market is simply currency traders who make money on movements in exchange rates, just like stock traders speculate the price changes for stocks. So I trade Forex. The Forex market is by far the biggest and most popular financial market in the world, traded globally by a large number of individuals and organizations and institutions. Its average daily trading volume exceeds 6.6 trillion US dollars. It's a 24-hour market. It's open from Monday morning in Australia until Friday afternoon in the US, which means you can trade morning, noon, or night. There are no commission fees, no government fees, no exchange fees, and no brokerage fees. Most Forex brokers earn money from the spread, which is the difference between the bid and the ask rate. There is no middleman. There is no middleman between the trader and the broker. Therefore, the trader is at liberty to trade online without having to go through a central exchange, which saves time and additional fees. Leverage gives traders the power to control much larger total contract volume than their initial deposit. Generally, traders get to trade for as much as 500 times their lever. So if you want to have an exposure, for example, of $12,000, you'd have to deposit only $25, which makes it altogether great. There is free practice. Most online Forex brokers offer free demo accounts for you to build your skills and practice trading, along with real-time Forex news and charting services, such as MetaTrader 4 or 5. This way, you can get a feel for trading without risking any of your own money. So, are there reasons not to trade Forex? Really, there is no reason not to give it a try. I used to think you have to be some kind of genius or a nerdy guy with a degree in economics to be a successful trader. But as I assume this is not the case, and I believe everyone can do it. With a little patience and the right training, you'll be able to do it too. So when to trade Forex? Although it's true that the Forex market is open around the clock, it doesn't mean that you should be trading every single minute of the day. Forex trading can be classified into three main trading sessions: Asian, European, and American. First of them is the Asian trading session from 10 p.m. to 7 a.m. London time. Usually in this session, exchange rates tend to range a lot, having short-term fluctuations resulting in breakouts later in the day. In this session, you will notice pairwise trading such as dollar to yen and euro to yen. At 6 a.m., the European session starts because about 30% of all Forex transactions come from London. You can see a lot of movement in European session. Most of the currency pairs volatility then quietens down in the middle of this session at around 10 a.m. when traders are taking a break and they are waiting for New York session to start. Just when European traders are getting back from their lunch, New York traders start coming into their offices as the first half of the US session overlaps with the European session. American session is from 12 p.m. to 8 p.m. You'll notice that the market has the most liquidity in this time. At around 3 p.m., you can often see rates start to raise, as London traders close their positions to avoid any overnight surprises. Then after 3 p.m., the market quietens down again until the Asian session opens. So now let's start with trading terminology, or where am I going along? Sometimes it can seem that the traders have their own language. They use words that probably make no sense to a non-trader. For example, imagine you hear a conversation like this. I'm going short on cable, but I'm also watching guppy. How about you? Well, I'm currently flat, but I'm looking to go long on channel. What these traders actually mean was I'm selling pound US dollar, and I'm looking for trade opportunities with pound yen. How about you? Well, I currently don't have any open positions, but I'm looking for an opportunity to buy euro pound. So here, I prepared a quick guide of the most common Forex words. Going long means placing a trade which is going to profit if the exchange rate rises. Or with other words, it simply means buy. Going short means sell, placing a trade which is going to profit if the exchange rate falls. Being flat, being neither long nor short, so you don't have open positions. Bulls are buyers, bears are sellers in financial markets. Impulse means sharp move up or down with high trading volume. Correction or a pullback is a slow move up, down, or sideways with low volume. Consolidation is a sideways move with low volume and no clear direction. Uptrend is when price is creating higher highs and higher lows. Downtrend is the reverse, when price is creating lower highs and lower lows. Breakout is a break of the current price structure, sign for a change in market moves. Now a few important currency pairs. Aussie, Australian dollar, or AUD, Kiwi, New Zealand dollar, NSD, Loonie, Canadian dollar, or CAD, Greenback buck, US dollar or USD, Swissy, Swiss franc, or CHF, cable pound to dollar, GBP USD, fiber, euro to dollar, euro USD, UP, euro to yen, euro JPY, GBP, pound to yen, GBP JPY, and channel, euro to pound, euro GBP. So how to trade with leverage and what is margin? If you trade in small quantities, for example, €1 at a time, you would never make any profit. That's why in the Forex market, currencies come in lots. Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. A lot is a unit measuring a transaction amount. When you place orders on your trading platforms, orders are placed in sizes, quantity lots. So 1,000 units form one micro lot, 10,000 units form one mini lot, and 100,000 units will form one standard lot. So right now you're probably thinking, I don't have that kind of money. Does that mean I shouldn't be trading? This is where leverage comes in. Forex brokers offer up to 500, even 2,000 to 1 leverage, some of them even more. That means that to open a one standard lot position, you need only to have about $300 in your trading account. So let's take a look at this example. Exchange rates for the euro-dollar is 1.3. You have your margin set at 0.2%. You decide to buy one standard lot, so you are buying 100,000 euros, which is equal to 130,000 US dollars. As your current margin is set at 0.2%, your broker sets aside $260 from your account. All this is considered to be a down payment. You will have to borrow the rest of the money to open a position. Of course, after you close your position, the money is returned to you along with your profit or your loss for the particular trade. So just remember, high leverage means you're also susceptible to large losses as well as large gains, so be cautious. Let's discuss leverage and margin and the difference between the two. The textbook definition of leverage is having the ability to control a large amount of money using none or very little of your own money and borrowing the rest from your broker. Margin is the amount of money needed as a good faith deposit to open a position with your broker. Margin is usually expressed as a percentage of the full amount of the position. For example, most Forex brokers say they require 2, 1/2, or 1/4% margin. Aside from margin requirement, you will probably see other margin terms in your trading platform, such as margin requirement, account balance, used margin, usable margin, margin call. Now let's discuss margin requirement. This is easy because we just talked about it. It is the amount of money your broker requires to open a position. It is expressed in percentages. Account balance, this is another phrase for your trading bankroll. It's the total amount of money you have in your trading account. Used margin, or only margin, is the amount of money that your broker has locked up to keep your current positions open. While this money is still yours, you can't touch it until your broker gives it back to you, either when you manually close your current positions or when a position is automatically closed by your broker. Usable margin, this is the money in your account that is available to open new positions. Or you can find it in your trading platforms also as free margin or available margin. Margin call, you get this when the amount of money in your account cannot cover your possible loss. It happens when your equity falls below your used margin. If margin call occurs, your broker will ask you to deposit more money in your account, and if you're not able to, some or all open positions will be automatically closed by the broker at the market price available, current market price. All right, so next, what is a pip? A pip is the exchange rate for a currency pair or a measurement of change for currency pairs displayed as decimals. 1 pip is equal to 0.0001. The exception here is the yen-based pairs, which are quoted with only 2 decimal places. Nowadays, some brokers are for fractional pips or pipettes to provide some extra precision, and they are displayed as a 5th decimal place. So how to calculate your pip value? The value change in the quote currency divided by the exchange rate ratio times the amount of units traded is pip value. Let's take a look at this example. The exchange rate for euro US dollars is 1.3. You have to divide the value change in quote currency 0.0001 by the exchange rate 1.3. And you have to multiply the unit of amounts traded. If it's a mini lot which has 10,000 units, the value will be 0.76. To convert this to your account currency, all you have to do is multiply this with your currency's exchange rate. So if you're living in the US, you have to multiply 0.76 by 1.3, which will be equal to 0.98 US dollars. So how to place a trade in Forex? In Forex, you exchange one currency for another, with the hope that the currency you bought will gain value against the currency you sold. In every single Forex transaction, there are always two currencies involved. This is because you simultaneously buy one currency and sell another one. The first listed currency is called the base currency. The second listed currency is called the quote currency. The exchange rate tells you how much you had to pay in units of the quote currency in order to buy units of the base currency. For example, you would have to pay $1.3 to buy 1 euro, or you would get $1.3 if you sold 1 euro. There are two prices when you're trading in Forex goods. The first one is the bid price, at which the broker agrees to buy the base currency in exchange for the quote currency. The price at which your broker plans to sell the base currency for the quote currency is known as the ask price. The difference between these two prices is called the spread. So if you want to sell a euro, you will sell it at a bid price. And if you want to buy an euro, you will buy it at the ask price. Types of Forex orders. An order is an instruction from trader to broker that shows how the trader wants to enter or exit the market. So here are some of the most common types of orders: a market order, a limit order, and a stop loss order. A market order is an order to buy or sell immediately at the best available price. This type of order guarantees that the order will be executed immediately. Just to remember that in the fast-moving market, price paid or received may be quite different from the last price quoted before the order was entered. This is in high volatility markets. A limit order is an order to buy or sell at a specific price. Buy limit is an order to buy at the limit price. This price will always be below the current market price. Let's take a look at an example. A trader wants to buy euros to US dollars, but he is only ready to buy if he can do it more cheaply. So he will place a buy limit order at a lower price, and the order will be executed once the market price comes to his buy limit price. A sell limit is an order to sell at the limit price. The price will always be above the current market price. The trader wants to sell, but only if he can sell at a price higher than the market price. A stop loss order is an order to buy or sell once the price reaches a specified price. It is designed to prevent additional losses if the price is going against you. It is the most important order of all. Consider that you have purchased euros to US dollars at 1.3, same example, and you realize that you made a wrong move, which is a very common case. When the price starts to fall, you place your stop loss order at 1.298. And when the price touches this value, your broker will close the position automatically, which contains your loss to 20 pips. If you had not set your stop loss, the price could have been continued falling, and depending on your risk appetite, you could have lost all of your money, which is not good and not recommended. So always use your stop loss orders. Now let's talk about some technicals. The theory for technical analysis is based on the presumption that you can forecast future price movements by studying historic market data. As it is believed that all current market information is reflected in price, you can assume that all you need to make a trade is price action, technical analysis, and study charts to look for patterns and believe that in similar situations, prices will act the same way as before. So for example, if a price had bounced several times previously, a technical analyst would think that it will also do the same the next time the price reaches this level. And so he sets his sell orders here. The more traders look for certain price levels and patterns, the higher the probability that these patterns will play out the way they think. Why is that? Because technical analysis is based on psychology. A chart is nothing more than a picture of human emotions. The market moves because of two primary emotions, fear and greed, which in effect compels humans to repeat past triumphs and mistakes. So remember, technical analysis is very subjective, and just because you see a pattern on the chart, it doesn't mean that the rest of the traders will interpret in the same way. Now let's see what types of Forex charts we have. When there is a simple line, the chart is called line chart. When there is a bars, it is a bar chart, and then a candlestick charts. So when there is a simple line that connects the open, low, high, and closing price, it is known as a line chart. This chart will look clean and there will not be any market noise captured in this chart, giving a clear indication of the resistance and support levels. Bar charts. Here is an example of a line chart. Bar charts show us the opening, closing, low, and high prices for each given section. The horizontal line on the left shows the opening price. The bottom of the vertical line shows the lowest price at a specific time period. The top of the line shows the highest price at a specific time period, and then the horizontal line on the right shows the closing price. This is the most popular type of chart in most trading literature. You'll find charts displayed exactly the same way. Candlestick charts display the same information as bar charts, but the visual representation is a lot better. The big blocks are called real bodies. On top of the vertical lines of the block, you can notice the upper shadow, and the lines that are under are known as the lower shadows. Usually, if the real body is in a lighter color, the currency closed above its opening price. But if the real body is in a darker color, currency closed lower than it opened. But don't worry about colors right now, because in most trading platforms, you can easily customize colors and charts as you like. The main advantage over any other chart is the excellent visual representations that the candlestick provides. It shows clearly who is in control, bulls or bears. I cannot say that any of the charts are better than the others, but I would advise beginners to stick with candles. So support and resistance in Forex. Support and resistance are two of the most popular concepts of technical analysis. These levels are prices at which there is a barrier where the price would either stop or reverse at a given level. Support is a level that prevents prices from being pushed downwards. Resistance is a level that prevents prices from being pushed upwards. There are three golden rules for support and resistance. First, the longer the price stays at the support or resistance level, the stronger it gets. This happens because the more obvious the level becomes, the more traders will be placing their buy or sell orders there. So when a support or resistance level breaks, the stronger it has been. And the stronger the next move will be. In theory, every support should become resistance, and every resistance should become a support. Here you can see, for example, the price was rising and met resistance. When it broke through, it was the same level from the upside and became the new support. The same can be seen in a downtrend. Price is falling, it meets support, and it manages to break through and tests the level, so this level will be the new resistance. Trend lines. Support and resistance lines can not only be horizontal, but they also can be diagonal. Diagonal support and resistance lines are called trend lines. They are drawn by connecting two or more prices, peaks, or bottoms. Trend following is one of the most basic and profitable trading strategies. You know, trend is your friend, and it is always like that. Let me explain how trend lines work. If the currency pair is in an uptrend, traders wait for the price to approach a trend line, and if it acts as support, they buy once the price bounces beyond the level. Conversely, if the price is trending down, traders wait for it to approach a trend line as the resistance and sell after it bounces down again. So remember, the more time support and resistance levels have been tested, the stronger they get, and the same goes for the trend lines. The biggest problem with trend lines is that unlike horizontal support or resistance, they can be very subjective. If you tell 5 different people to draw a trend line, you will get 5 different trend lines. Here is an example for uptrend, and the price is bouncing several times from the trend line. As you see, in every bounce, in every touch of the trend line, you can open a buy order there. Once broken, the trend line, if it was a support, becomes a resistance. And you can see here in this example how the price touched the trend line from the downside and it reacted. Shortly, but it reacted. And here is an example of a downtrend. Price is falling, you have a downtrend, you draw your trend line, you see how price touched the trend line 4, 5, 6 times. Then the price broke the trend line and the resistance trend line now becomes a support. It got tested and then the price went up. All right, trend channels. Trend channel is another great tool for a trend trader. In order to make a channel, all you have to do is draw a line parallel to your trend line. Channels are a great tool for setting your price target. So let's take a look at this example. If you just went short after the price bounced from this falling trend line, you didn't know where to take profit. If you draw a trend line parallel to your trend line, you can project where you can put your take profits. So based on it, you can calculate your target profits. Channels are you can find them in every charting platform. They are automated tools. You just have to pick 2 points in downtrend or in uptrend, and then 1 point in between, in the middle of these 2 points, up or down, and you just you will have your channel drawn for you. Okay, guys, that was today's lesson. I hope it was interesting and valuable to all of you here. And I can't wait to see you next week for our second lesson in Validus Trading Academy. Thank you so much for being here and see you next week. Bye-bye.